This video will cover the second part of limitations of financial reports. So last video looked at normalised earnings, capitalising expenses as well as valuing assets. Okay, this will look at timing issues, debt repayments and notes to the financial statements. So what do we mean by timing issues? Depending on when the business's financial year ends, so either the end calendar year, 31st of December, or the financial year, the 30th of June, that could potentially lead to a business overstating or understating its financial position. Businesses can exploit timing issues in financial statements, which could lead to a misleading impression of the financial position of the business, and really limits the usefulness of those particular reports, so the balance sheet or the income statement predominantly. So for example, revenues for the business and money coming into the business could be delayed, or indeed they could be accelerated to manipulate them into or out of the period covered by the report to give an inaccurate picture of the business's earnings. So for whatever reason, the business might want to delay revenues to make that particular financial year's revenues look worse than they actually were, and to make the following year's revenues better. Or conversely, a business might want to accelerate revenue into this particular year and not have them occur in the following year, which again will create, because of the timing, will create a distorted and inaccurate picture of the business's performance for that particular period. Debt repayments. The issue of debt repayments, again, can also limit the usefulness of reports because it might not be exactly clear when those debt repayments need to be made, and that can again give a misleading impression of the position of the business, or the financial position of the business. Businesses can renegotiate with suppliers and banks to delay their debt repayments, and those renegotiations can lead to a misinformation about the position of the business. The recording of those debt payments also on the financial reports can distort what is actually happening at the business. And a business might do that to provide a more favourable overview of the business at that point in time. Lastly, the notes to the financial statements. Notes to financial statements are attached to the primary statement, so we just see the balance sheet, income statement, cash flow statement in a quite simplistic way. But for big businesses like National Australia Bank, for example, they might have 50 or 60 additional pages behind all those financial statements, indicating detailed information about certain aspects of items that appear on the income statement and items that appear on the balance sheet. And those notes can also limit the usefulness of those financial reports. Information in those particular notes can be quite subjective, and therefore they could be misleading and limit the usefulness of the report. The notes may add extra information not included in the main report, and often that's what they do, which explains, for example, the accounting method used or the reasons for certain financial outcomes. One of the original limitations of financial reports was that notion of normalised earnings, and that is something that would appear in one of the notes to the financial statements, is the normalising of, for example, a property sale. And that's that information which, if not looked at, could definitely lead to some misleading information. The notes aren't regulated by law, as strictly at least as the actual financial report, so the balance sheet or the income statement, so they might in fact be used to mislead stakeholders, both internal and external. So there's three more additional limitations of financial reports: timing issues, debt repayments and notes to the financial statement. The next video will cover ethical issues that relate to financial reporting.